Thank you for tuning in to the Generational Wealth through Commercial Real Estate Show. I got a very special guest lined up for you today. But before we get into that, if you're watching this show for the first time, do me a favor, go ahead and hit the subscribe button because this is how I keep growing my show. And if you haven't left a review, please do so now. These reviews are how I'm able to bring on rock star guests like I have today. But that's enough for the housekeeping. Let's get to today's guest. Today's guest is Jorge Brew, right? Is that how you say your last name? I always crush last name.
It's a Brew, a Brayu. They both work.
All right, let's go with that then, man. He is the CEO of Elevate Commercial Investment Group. He also owns a construction company, JNT Construction, that focuses on helping multifamily investors with their full renovations. Jorge has been investing in real estate for over 14 years now. He started in single family and small multifamily properties. He has wholesaled over 200 properties, fixed and flipped over 100 properties, and developed several new construction projects, over $8 million in ground up developments. For the past 3 years, he has been focused on large multifamily properties. He currently is active and passive full-time multifamily real estate investor. He has 1,720 doors on the GP side and 1,400 doors on the LP side. He currently have 850 doors under contract on the GP side now. So, Jorge, you crushing it right now, man. I'm sure my listeners are excited to really learn something from this episode. So I appreciate you coming on the show today, man.
Thank you. I'm excited to be on the show.
Absolutely, man. So, obviously that was a really quick rundown on what you're doing right now, but, give us a little backdrop on who you are.
Yeah, so I was born and raised in South Florida. Both my parents are Cuban. And, going to, I guess this whole real estate journey started sometime in college. I was studying to be an electrical engineer. Kind of decided at some point that really wasn't the path I wanted to go down. Ended up getting my degree anyhow. Worked in the engineering department at UPS for a few years, but throughout that, getting my degree and then also working at UPS, I was educating myself on real estate investing, and I was doing some deals. Finally grabbed some traction and started closing enough deals where I felt comfortable enough to quit my W-2. That was actually, I looked at it the other day and it was 16 years ago. 16 years ago when I started looking into real estate and started going down that path.
Yeah.
And then I guess 14 years from when I went full time into real estate. And then, started hitting the single family hard. That's where I started. Mainly doing fix and flips and wholesales. We did have some holds, some smaller multifamily as well. And then really about 4 years ago or 3.5 years ago, started looking into multifamily syndications and large multifamily properties.
Yeah.
Didn't really know that side of the business. As far as, I didn't even know what a syndication was.
Right.
But when I got introduced to that, I felt like that was the true path I wanted to head down, and that was going to be the tool for me to create the generational type wealth that when I decided to go into real estate, that's what I was seeking. Yeah. And that's what led me down this path. I was doing single family and multifamily together for a little bit, and then decided to focus on multifamily. So I stopped doing single family. Opened a construction company. I guess I didn't mention that, but opened the JNT Construction a couple years into real estate investing, and that was to scale the fix and flips originally.
Yeah.
Kind of taking the same concept and just put all my focus towards multifamily and commercial construction. And for our deals, we mainly use my construction company to do the capex. I know it's going to get done right. I know it's going to get done in a timely fashion.
Yeah.
and it's really helped us to get to where we are now.
Yeah. No, that's awesome, man. So, obviously there's a lot of different asset classes that you can invest in. Why did you, specifically decide to go with multifamily?
I felt it was the safest space, as far as, you're always going to have individuals that need a rent versus own, or want to rent versus own. Our population only continues to grow.
Right.
Obviously, you've got to be specific on what area you're going to get into. But if you pick the right area and you come in at a good basis on a multifamily property, and you do a good job managing it,
right.
I don't see a better class to be in. Storage interests me a bit, but the returns on that are going to be maybe safer, but not nearly as high as they can be on multifamily. So, yeah, man. I'm all about the multifamily.
Got you. No, that's it's definitely good to specialize, because then you can become really good at something. So what are you doing right now to help you find your deals?
There's the usual, right? We're always reaching out to the brokers, the ones we've built relationships with new ones, kind of staying in front of them, letting them know we're here.
Yeah.
We can move quick if you got a good deal.
Right.
We don't want to just be bidding on the same stuff everybody else is seeing.
Yep.
And then co-GPs, individuals that maybe don't have the portfolio yet and need some help to get some deals closed.
Yeah.
Been going after that quite a bit, and just letting everybody know, hey, we're here. I'm 100% okay with co-GPing as far as, if I think it's going to be a good fit.
Yeah.
So that's been quite a bit of leads coming that way. And then what else we got? Just working on the systems to be able to go through these deals quicker.
Yeah.
Man, the last 3 weeks have been insane with how many deals are popping up. Everybody was kind of holding them, and they didn't want to put them out there because of what was going on.
Yeah.
And I guess now that the cases have dropped on COVID, and everybody decided, okay, here we go.
Right. So if you could, man, for the people that's listening to this, a lot of people are newer and they're trying to get into the space. What does a typical co-GP look like, or what would you be looking from that GP partner if they're bringing you a deal? What role would they have in the general partnership?
It depends on how much they're gonna put in. I'll give you an example. Are you literally just forwarding me something and saying, here's 300 units over here, and looks good?
Right.
Or are you sending me a detailed underwriting? You've done all your homework. You've called the city and found out I don't know what, and you've done this and that. And you've got maybe experience in asset management. There's just, we look at everything. Depending on what you can bring to the table. Do you have net worth and liquidity for the loan, or are you gonna bring any equity? Are you not? So it's hard to say, but we're definitely fair with the way we split things up, and we're not looking to give somebody just peanuts, for bringing a deal. So I prefer for some research to be done before it's sent to us, and I've got sort of like a criteria. I mentioned the system, sort of like a criteria. Hey, this is, if you're gonna send us something, this is what we need to see.
Right. No, that's a great answer for it. Obviously it's variable. It depends. It depends on where you're at, as an investor. You know, whether you have money, if you don't have money, you know, are you going to put in the sweat equity to show that you can bring value to the table?
Correct.
Because it's all about adding value to people.
Yeah.
I forget the quote, but it's a quote out there that says, you know, you either if you don't add value to someone, you devalue them. So, you know, that's
that.
That's a great quote, man, and I try to live by that for sure.
Nice.
Okay, man. So, you know, if you can, because, you know, obviously, man, I like to go back to people that's just getting going. If you can remember, obviously, you was doing the flip, you were doing the wholesaling, so your story, your trajectory is a little different. But what was the biggest challenge for you when you initially said, okay, I'm ready to syndicate, I want to start doing bigger deals? What was the biggest challenge you faced?
The biggest challenge, you know, I think if you're starting from scratch, the thing that took the longest and the biggest challenge was really knowing the underwriting, you know, really understanding what multifamily is, and the fact that you're buying a business, you're not necessarily buying a property. You know, it's not like single family where, okay, I'm just going to pull the comps and see what this is worth.
Yep.
No. You got to look at the financials. You got to dig into the financials. You got to know how a property's valued. And so, I mean, really learning the ins and outs of underwriting. Look, I'm an electrical engineer. I'm really good with math. You know, I was taking calculus 3 at the end of high school. Like, I'm really good with math, but underwriting still took me some time, man. You know, it still took me a while to get it. And a lot of it is kind of the, you know, knowing the rule of thumb for certain things, and when to use one, when not to use one. And that some of that stuff only comes with experience, or so I mean, I underwrote a lot of deals before we landed our first one, and
So man, let's go ahead and jump into underwriting then. You know, when you're underwriting deals, you know, what do you look for? You know, just a quick underwriting, because you mean, obviously, like you said, you got a ton of deals coming, so you can't go through a deep underwriting on every one. So, what are like those quick, you know, 2 or 3 things that you look for to say, okay, I'm going to go deeper or not on this one?
Yeah, you know, some of that's changed with COVID. Before COVID, I would focus a lot on, okay, what's the price per door going in, right? Yep. What's the current rent, and what's my true market rent? And I would see how much, you know, one, is it valued correctly right now at the price per door and the rent they're getting, and obviously the NOI, and how much would that be worth if I can really raise the rents to the market rent. Now we're looking more at more for a deal that's a little more stable as we come in, and so we're paying attention to the cap rate, the going in true, you know, T12, maybe T3 on the income, depending on what's going on. Cap rate, and then seeing, I still want to be able to add value there, so, you know, also looking for some type of value add. So we come in, it's cash flowing, and then we start working on that value add. Cash flow increases, value increases. I'm not sure if that's kind of the answer you were looking for on that one, but
well, more specifically, well, I guess a better way to ask the question is, when you're looking at a deal and you're underwriting it, the quick underwriting of it, what will turn you away from it? Like, what are the red flags and say, okay, this is, you know, throw this in the trash? You know, what is that? What are those you look for?
Going in cap. I mean, if the going in cap is a 3% or 4%,
right?
Just not gonna do it right now.
Right. Yeah, and you know, these cap rates are getting compressed. I'm in North Carolina, so Raleigh and Charlotte, man, the cap rates are compressed like crazy over here. And you know, I see some groups taking them down. I'm like, how are they? I just don't get it, man. I don't know how they're buying these deals, but they're doing it somehow, man.
Yeah, I mean, they got investors that I guess don't expect high returns, and
Yeah,
yeah.
yeah, yeah, for sure, man. It's crazy. But okay, well, markets wise, obviously you said you partner with some co-GPs and you're finding deals that way. But what markets are you, specifically targeting right now?
Um, we still like Houston. We got quite a bit in Houston, and it's got its real area specific within. I mean, Houston's massive.
Yeah.
So specific areas within Houston and around that market. I love Dallas, man, but it's I'll keep looking.
Yeah.
But it's hard to find a deal that makes sense at the pricing. So a lot of the submarkets around Dallas, around Houston, even around Austin.
Yeah.
And then Oklahoma City, I still feel comfortable in some of those areas. One surprising one is South Dakota, which is our current deal that we're raising for is there, and we just landed another one there. So it's an interesting market.
Now, now South Dakota, man, I gotta ask you, what is it about South Dakota that you like?
Just going back and looking at the metrics, and one specific thing is how they handled COVID. I mean, the economy there it was like nothing happened.
Yeah.
So, you want to say pandemic, I guess you can't say proof,
right.
but resistant.
Yeah.
So that's definitely a plus. I like North Carolina, but like you said, it's tough there too.
Right.
I think hopefully we'll land something. Maybe not in Raleigh, but one of the other markets.
Yeah. Hopefully I can assist in finding you something that makes sense out here, man. The deals are coming. They're definitely coming. It's just patience and waiting for the right one, right?
Yep. And there's going to be opportunities popping up, man, with some of especially depending on how this continues to go.
Yeah.
As far as COVID.
Absolutely. That's for sure. What is one rookie mistake you see people making now, especially with COVID happening? Things are changing. What is a rookie mistake you see people trying to get into the business making now?
Rent growth. Don't you're forced appreciation on the rent growth, and so two things, right? Your organic rent growth that you experience in that market yearly.
Yeah.
Assuming that you're going to continue to, we've been in one of the best markets before COVID hit.
Yep.
If you're going to take that 3% or whatever it was as the organic rent growth and continue it, I think that's a mistake. Don't assume you're going to continue to get that rent growth, and then pushing the rents too high.
Yeah. And when you're saying pushing them too high, you're talking
in the projections
to, when you're doing your renovations and what you're projecting it to go up to.
Correct. Like if the market rent's 700 and right now it's 500, and in your projections you're increasing everything after year one to 700 because you're assuming you're going to get that. Don't assume that.
Yeah. It's better to be conservative and
absolutely.
And, conservative is always better for sure. If you beat it, then hey, that's a plus, right?
Yep. Take concessions into account too. I mean, there's going to be more and more concessions if the government can't you know, we got elections coming up too. I mean, man, we just got
Yeah.
so much unknowns right now.
Right. There's a lot of unknowns. So concessions and even bad debt. You know, that's something else to pay attention to. Okay, man. Well, let's go ahead and segue to the next segment of the show. It's a deal deep dive. So let's talk about a deal you did. You know, where was it at? Units. What was the value add strategy? And you know, just of it like that.
Yeah, I guess I can. You know, we're getting one ready to refi right now. We bought it last summer. Value add deal in Oklahoma. 216 units. We came in and with a capex budget of around 1.1.
Yeah.
And we fixed up some roofs. We repaired some sewer lines. We replaced some AC units, some water heaters. Painted the whole brick and everything. Gave it a nice curb appeal. Replaced all the signage. Renovated the leasing office.
Yeah.
What else we did there? We added some solar screens. And then the units, you know, we upgraded close to about half of the units.
Yeah.
We're able to get our actually we passed our projections on rent as far as the rent bump, and we are above 90% occupancy now and working on the refi.
Yeah. So the units themselves, well, it sounded like you did a lot of work outside of the property for curb appeal purposes and just, you know, longevity of the asset. So one question I want to ask there, on every deal that you do when you're doing your due diligence on it, do you scope the sewer lines? Is that how you found this sewer line issue?
Yes, it is. We actually ended up having, so you know, you get kind of mixed reviews on this as far as scoping the lines beforehand, because a lot of the times you're going to have grease buildup and you're not going to be able to see everything when you scope them without jetting them. Yeah. And you're not going to jet the lines before you actually own the property.
Yeah.
So my opinion, I think you need to scope them anyways. I think you get a decent idea of what you're working with. So we did discover one when we did that. We knew there was one issue.
Yeah.
But knowing that there was that one issue and that we couldn't quite see everything, you know, we put a larger contingency in there. You know, we didn't just say, okay, it's going to be 15 grand to fix this one spot.
Right.
I can't remember the exact numbers, but we maybe doubled that or something like that, and we ended up having to use it. So yeah.
Now, were you able to get the seller to credit you for any of those things that you found during your due diligence period?
We did. We did a small retrade on this one. We didn't ask for anything crazy, but man, I can't even remember the specifics. I know one did have to do with the plumbing.
Right.
So that was thrown in there, and then there was something else. I think it was a fire damage unit that they hadn't told us about, or something. So, you know, to me, like, if we're asking you questions up front and you're not giving me the right answers, and I need to discover it during due diligence, I mean, that's a good reason to retrade.
Absolutely. Okay, and then just as far as the inside upgrades, what level of upgrades did you do? Because, you know, there is such a thing as overdoing, you know, renovation.
Yeah.
So how did you determine how much to go into that?
So we paid close attention to the market, right? So, and this is a mistake I've seen before too, especially with Oklahoma and some Dallas investors. You know, in Dallas, man, you can get a large return on your investment. You know, you put 10 grand into a unit, you can easily get that back depending what class and where it's at. But in this, and this is a lot in Oklahoma, so it's a smaller sub-market in Oklahoma. That's not the case. You know, you're going to get a smaller rent bump. So we didn't go nuts. We replaced the light fixtures, the plumbing fixtures, made it all brushed nickel.
Yeah.
We didn't do any cabinet fronts. We just painted the existing cabinets.
Yep.
Didn't replace any countertops. We just resurfaced the countertops. Same with the tubs and the tile surround. We just resurfaced it.
Yep.
And I think that was it, man, as far as our upgrade. We did some flooring where needed.
Yeah. So it was what, all in maybe 3?
A little bit more than that. I think there was appliances on some of them too.
Okay.
And depending on the appliances and flooring, that's obviously going to change
Right.
that number drastically. So
Yeah.
it was maybe between 3,500 and 5,500, or
Yeah.
yeah.
Gotcha. Okay. And you guys are getting ready to refi, and what the plan is to hold this, what, maybe another 5-10 years after refi?
Yeah, I mean, this one was built or structured for, we could hold on to it for a while. We're gonna, depending with the reserves right now, but we should be able to cash out our investors, return all their capital.
Yeah.
So at that point, the returns are infinity, right?
Right.
So with that in mind, then we can really just hold on to it for as long as we want.
Yeah. Now, I know some groups, when they do the refi, they refi the investors out of the deal altogether to give them the money back and say, hey, let's go find another one. And then some groups will refi, but you still hold a equity stake in the asset. How do you guys structure yours?
They still hold equity stake in it. We don't change what they own.
Yeah.
The property. And yeah, I mean, I've seen it structured differently, like you said, but
yeah,
on this deal, we did not do that.
Gotcha. No, that's cool, man. Sound like you got a solid deal there, home run. Now there is something I want to ask around the financing side, because we're in COVID and they are having you put up some reserves, more than what you normally would. What are you seeing right now as far as that goes?
So we refied one. When was it? Maybe a month and a half ago. Same type of deal, it was a bridge, and we did a refi cash out. Want to say they ended up sticking us with a 12-month reserve on that one.
Yeah.
I have heard that I believe they're lowering it to 6 months now.
Yeah. And that's taxes and insurance.
Yes, I believe so.
Okay. Gotcha. All right, man. Yeah, that's always good to know, because, man, if you don't, properly account for the reserves, that can blow up all of your projections that you was, think you was about to get. So it's definitely good to have a good lender on your team, right?
Yep. I think COVID's made a new definition for reserves.
right, for sure. Well, in the I guess grand scheme of things, you do get to get the money back once you hit a 12-month or however many months it is threshold, right?
Correct.
Yeah.
Correct.
Yeah, so that's still good.
Still
all
good,
right, man. Yeah, for sure. All right, last round, man. We're going to the lightning round. Let's go ahead and jump into it.
All right.
What's the best advice you ever been given?
Best advice I've ever been given. That's a good one. Man, I've been given a lot of good advice. I guess I'd have to go back to the advice I usually give, man, which is focus.
Yeah.
Like we were talking earlier, you were saying all the different asset classes. Don't be a jack of all trades. Focus. Choose what you're passionate about and go after that. I'm not saying don't. It's great to have several streams of income, right? But be the master of something.
Right, for sure. What's the best book you've read this year?
This year, And I like this one. I'm about done with it. It's the 4 disciplines. Sorry, I'm checking my Audible.
No, I'm good.
I
I
want to
think I
say
got
it
the
right.
same book. It's what is it? 4 Disciplines of Execution.
Yes.
Yep.
Yeah.
I got that book too, man.
It's similar to Traction. I don't know if you can see it there in the background. But it breaks it down even easier.
Yeah, for sure. All right. So, what are some rituals that you've created that's making you a better investor or person in general?
Person in general, you know, I'm all about you got to take care of yourself as well. So
Yeah,
you know, every morning I work out, and I watch what I eat. I guess that's a routine in a sense, but you know, and that to me that makes a huge difference. It makes a huge difference in your energy and everything. So
right.
yeah.
Gotcha. All right. So, what is one thing that you're focusing on right now to help you improve your business?
One thing that I'm working on. Constantly working on new systems and procedures. Pretty much I pick one aspect and I work on that, focus on it, get it all set up.
Yep.
And then move on to the next. This second, working on our equity raising.
Yep.
Really trying to take that to the next level.
Yep.
You know, it's one thing that when I started doing this, when coming from single family, I didn't really raise equity. We had a couple private lenders. We used hard money lenders at some point too.
Yep.
So that was definitely new for me. I love marketing though, so
yeah,
I feel like I've got that, and now it's just putting a little bit more systems in place.
Gotcha. If you can give your younger self one tip in regards to investing, what would that be?
Skip single family, go straight to multifamily.
Easy to know. What's the worst job you ever had?
Worst job I ever had. First job, I guess, bag boy at Winn-Dixie, then Publix. You know, I still did it with pride and still gave it 110%, man. But
yeah, I got you, man. All right, and last question here, man. You know, you got a rich uncle. He left you $1 million. What are you investing it in?
Whew. What am I investing it in? Passively or actively?
Yeah, man, you got $1 million tax free. What you doing with it?
You know, I'm definitely gonna invest some of it passively.
Yep.
So I can get some depreciation.
Yep.
And not get taxed on. Oh, you said tax free, but
yeah.
So I'll roll over that depreciation. And then you know, it depends. I may look at possibly a business that will, you know, if it's me right now, maybe look into purchasing a property management company and bringing property management in-house.
Yeah.
I don't know. I'd have to look at the ROI and.
Yeah. No, I'd like to ask that question there, man, because it's just interesting to see how some people say, man, I'm going to put it on black in Vegas or something.
Wow.
Yeah, man. But that's the end of the show, man. I appreciate you coming on today. You know, tell my listeners, how can they get in touch with you?
Man, if they check out, we're constantly updating our website, elevatecig.com. You can find a ton of free content on there, information about any of our deals that we have going on. And if they want to shoot me an email, which is George or Jorge, Jorge at elevatecig.com. If they mention this podcast, I'll shoot them over. I've got several different checklists, like for due diligence, CapEx, questions to ask a deal sponsor before investing. So I'll go ahead and send that over to him.
I appreciate that, man. Thanks for coming on the show today.
Thank you, man. Thank you. Fun like always.